Tax implications of special circumstances represent an important area of financial planning because many life events trigger unique tax consequences that can significantly affect a client's financial position. While general tax rules apply broadly, special circumstances often require planners to evaluate additional provisions within the Internal Revenue Code. These situations may include supporting elderly parents, caring for adult dependents, funding higher education, divorce, disability, healthcare needs, and other family-related events. Congress frequently uses tax laws to encourage or discourage certain behaviors through deductions, credits, exclusions, and exemptions. Financial planners must understand these provisions to help clients maximize available benefits while maintaining compliance with tax regulations and achieving broader financial planning objectives. Supporting elderly parents or dependent family members can create valuable tax planning opportunities. Taxpayers who provide significant financial support for qualifying dependents may be eligible for dependency-related benefits, deductions, and credits under specific circumstances. Eligibility often depends on income thresholds, support tests, residency requirements, and other statutory criteria. Financial planners must understand the rules governing dependency claims because multiple family members may contribute support to the same individual. Proper documentation and planning are essential to ensure that available tax benefits are utilized effectively. As populations age and multi-generational households become increasingly common, dependency-related tax planning continues to play an important role in comprehensive financial management. Education planning presents another area where special tax provisions significantly influence financial decisions. Congress has created numerous incentives to encourage post-secondary education through tax-advantaged savings programs, deductions, credits, scholarships, and grants. Financial planners evaluate how these provisions interact to determine the most beneficial funding strategies for clients. Tax incentives associated with education may include qualified tuition programs, education savings accounts, education credits, and deductions for eligible expenses. Because certain benefits cannot always be used simultaneously, careful coordination is required. Effective education tax planning involves balancing current saving strategies with future tax opportunities to maximize overall after-tax benefits and reduce the cost of educational attainment. The choice between education-related deductions and credits often requires detailed analysis. Taxpayers may qualify for benefits such as the American Opportunity Credit, Lifetime Learning Credit, tuition-related deductions, or tax-free educational assistance. The relative value of these options depends on income levels, marginal tax rates, filing status, and the nature of educational expenses incurred. Financial planners evaluate both current and projected tax circumstances to determine which combination of benefits provides the greatest economic advantage. Since educational funding decisions may affect financial aid eligibility and future tax outcomes, planners integrate education tax strategies with broader financial planning objectives, including savings plans, investment management, and family cash flow considerations. Divorce represents one of the most financially significant special circumstances affecting taxation. Property settlements, child support arrangements, retirement asset transfers, and alimony-related obligations may all create important tax consequences. Financial planners must understand how these transactions are treated under applicable tax laws and how they affect each party's financial position. The tax treatment of payments often depends on legal classifications and specific transaction structures. Understanding these implications helps clients negotiate more effective settlement arrangements and avoid unintended tax consequences. Because divorce frequently impacts cash flow, retirement planning, estate planning, and wealth accumulation strategies, tax planning remains a critical component of comprehensive divorce-related financial advice. Charitable and philanthropic contributions are important tools for both personal fulfillment and tax-efficient financial planning. Many individuals and families incorporate charitable giving into their overall financial strategy as a means of supporting causes they value while potentially receiving tax benefits. Charitable contributions may involve cash donations, appreciated securities, real estate, business interests, or planned gifts through trusts and other charitable vehicles. Financial planners help clients evaluate giving strategies that align with personal values, financial objectives, and tax considerations. Effective charitable planning allows donors to maximize the impact of their contributions while integrating philanthropy into broader wealth management, retirement, and estate planning strategies. Tax deductions associated with charitable contributions can significantly reduce taxable income when contributions meet applicable requirements. Deductibility generally depends on the nature of the recipient organization, the type of property donated, valuation rules, and substantiation requirements. Donations of appreciated assets may provide additional advantages because donors can potentially avoid recognition of embedded capital gains while receiving a deduction based on fair market value, subject to applicable limitations. Financial planners analyze the tax implications of various gifting methods to determine the most efficient approach. Proper documentation, valuation, and compliance procedures are essential to preserve deductibility and ensure that charitable objectives are achieved effectively. Tax implications of special circumstances and charitable contributions illustrate the importance of integrating tax planning into every stage of the financial planning process. Life events, family responsibilities, educational goals, healthcare needs, and philanthropic objectives frequently create unique tax opportunities and challenges. Financial planners evaluate these situations holistically to identify strategies that improve after-tax outcomes while supporting long-term goals. Whether advising clients regarding dependency benefits, education incentives, divorce settlements, or charitable giving arrangements, planners must consider both current and future tax consequences.